Oh,
Oh, thank you.
someone said you guys are LinkedIn superstars. Thank
Thank you
you.
so much.
All right, I think we're good to get started. Um, Thank you so much for everyone that's on. We're very grateful. Thank you. I'm Alexa Linsky. This is my dad, Ryan.
Hi,
Um,
everyone.
and today we are going to go through the market update, year to date 2026, what is out there in the franchise finance lending environment. We're experts, and our goal is to make you all mini experts. We're going to have a live Q&A at the end. I believe myself and my dad are the only ones that could see your questions. So drop them in the chat or in the Q&A, and we will get to them at the end.
Yeah, we have over 80 people signed up. I'm not sure if everyone will be on, but thank you all for your time. We know you're busy, and as Alexa said, we're excited to share our expertise with you and help you out.
Great. All right. So we are expert franchise finance loan advisors, as stated before, companies Linsky Capital. Ryan is my dad. He has been doing this for over 28 years. He formed our company so that we can help any bankable franchisee with financing, as well to start something for our family. So we are allied with over 50 franchise lenders across the country. How we work is we understand exactly what the franchisee's financing needs are. We bring them to a lender that is best fit for their specific need, and we guide them throughout the entire financing process. On top of that, we negotiate the franchise, everything on the franchisee's behalf. And something we wanted to point out, it is not just about the rate. We're going to go through that today. What else is just as important? We're able to secure very competitive deals for clients because the lenders want our business. And we can also get super creative. So, a quick scenario, let's say someone has financing for new unit development. We have a few different routes that we can go, which we're going to go over today, right? So, one might be to refinance your debt and add a line of credit. One might just be knock out your new unit application only. And we're going to go over those products. And something we wanted to mention is that we are not limited on who we can work with. We help first-time franchisees who are opening or buying their very first unit, all the way up to we have helped the largest franchisees in the entire country in top tier brands. We are not limited on loan amount. So if you need, $5,000 for a new AC unit, we can help with that. If you want to refinance all your debt and get a huge line of credit, we can help with that. We're just looking for bankable opportunities.
Yep, and just to jump in here, so as Alexa mentioned, I've been doing this for a very long time. I joked that I used to have a full head of hair when I started. I looked similar to Alexa, if you could imagine. So when I worked for mid-ticket conventional lenders for many, many years, it was frustrating when I had deals that were bankable, but the loan amounts were too small, or they were SBA, they were too large, maybe leverage was a little too high. And I was on my boat one day and I said, I'm going to make the jump and just help anyone with any loan size, as Alexa mentioned, as long as it's bankable. And a little tidbit is that in our logo, people say, well, why is there a lighthouse? And we're from Jersey. You guys are safe. I always joke around, but we're big boaters. And when I was on the boat, I was right next to the lighthouse when I decided to make the jump and form Linsky Capital over 7 years ago. And the lighthouse, the idea is that we'll guide you to where you want to go. That's the idea about it. And some other things about us basically is that we're a boutique lender and a boutique advisor, I should say. And what I mean by that is that we're small. So it's Alexa, myself, and we have Isabella in charge of new business development. If you've never spoken to her, please take her call. She's got a lot of energy and great to work with as well. And we want to keep it small. We're going to add a few more people to the team, but we work really hard like you. So we're working nights, weekends, and we like the personal touch, the personal approach, very relationship driven. And then lastly, I just want to mention that most franchisors have what they call a preferred lender list. And it's great. They'll say, hey, listen, no, we vetted these, let's call it 5 different banks. or lenders, and these are people that we recommend. What's happening more and more is that the franchisors are now just referring a lot of their franchisees, big or small, to us at Linsky Capital, because even when there's a preferred lender list, you, the franchisee, and we also have franchisors and attorneys and accountants on the call, but as a franchisee, you still have to go through that list. And you're trying to run your business, and you are not an expert in financing. Like, we're not an expert in running your stores. So basically, when you work with us, you work with all those lenders, as well as many more, including what we call pocket lenders that maybe don't attend conventions, people don't know as well, but they may even be more aggressive on rates, terms, conditions, ability to grow with you, et cetera. So I just wanted to add that on the About Us part here. Okay, so let's dive into the process of how we work and get rolling with you. So first, we set up an introductory call, on average, maybe a 30-minute call. We always say you have nothing to lose, but you may have a lot to gain. Sometimes when people jump on the call, they say, I'm glad I finally did it. It was really worth it. We help them out. So basically, during that call, we're going to ask a lot of questions. We want to know where you've been, where you are, and where you want to go, because all three things are very, very important to us. From there, we're going to ask questions such as how many units do you have? Maybe it's your first unit. How long you've been around, i.e. your tenure. How has business been? Your EBITDA after G&A, sales trends. What are you looking to do within the next couple of years in terms of growth, relocations, remodels, just a lot of questions, your liquidity. So what we're trying to do here is respect your time. We're trying to get to know you and develop a relationship and really understand what you're about. So we, in our minds, start understanding where maybe we would take you, which one of our lenders might be the best fit for you, okay? So we ask a lot of preliminary questions. From there, if it sounds like a bankable deal, we then send a checklist. That checklist is going to be a basic financial package of last 3 year-end financials, per unit and consolidated. It's going to be last 3 years corporate tax returns, year-to-dates with comps, so we can see sales and EBITDA trends. We're going to ask for, of course, personal information, like a personal financial statement to check liquidity, personal tax returns to uncover any other businesses maybe you own that you didn't mention before. And of course, a debt schedule and other what we call pertinent information for us to obtain, review, and qualify the opportunity. What we don't want to do, again, is waste your time, and we don't want to bring a deal to a lender that is not a bankable deal. So when we call our lenders, they pick up the phone, they want our business because they know it's qualified. From there, that's when we do call our lenders. So we start saying, listen, this is the opportunity. We summarize it. This is why we believe in it. We even address pros and cons of the opportunity even before they mention the pros and cons, right? Any hurdles, it's always best to hop over the hurdle early than have a late surprise and hit a hurdle and fall down. From there, if the lender is interested, we gather a loan proposal. We negotiate that proposal or have pre-negotiated that proposal. And as Alexa mentioned, it's not just rate. It's the borrowers, it's collateral, it's prepayment language. It could be, if there's treasury management, it could be covenants, which is very, very important. It could be a line of credit size, whatever it may be. We're going to negotiate that proposal for you. We'll send it to you along with our consulting agreement. So up until then, everything we do is out of good faith, showing our expertise and qualifying, okay? Once it becomes a proposal stage, that's when we send our consulting agreement and say, hey, listen, if you want to proceed and you're serious, sign the proposal, sign our agreement, let's move forward together. It's a very high likely chance that the deal would get approved at that time. We do ask for a deposit to make sure that you're committed and serious about moving forward, which is typical in the industry in regards to getting a deposit. From there, we go into credit underwriting. We make the introduction to the lender. We say, okay, here's the signed proposal, anything else you need, an application, whatever it may be. Depending on the lender, we'll go over this in the upcoming slides, but depends on how long a deal is in credit. From there, the deal gets approved, hopefully. Then, of course, document due diligence. They're going to be obtaining copies of executed franchise agreements, lease agreements, including the options, good standing certificates, lien searches, all that fun stuff. And then, of course, eventually we cross the finish line, funds go out, and the deal has commenced. And that's the basic process.
Okay, now we're going to get into the types of financing real quick for anyone that joined late. We're going to do a Q&A session at the end. I saw some questions pop up. One of them was, will this be shared? Yes, we're recording it, so we will share it after. Okay, so the types of financing we can help with. The first is a refinance. A lot of times that is coupled with a line of credit. Lines of credit typically go out for 18 to 24 months. Acquisitions, new unit development, remodels, equipment financing, working capital. We're going to talk about this. We have lenders that could do sole working capital loans, partner buyouts, owner-occupied real estate. So if you're buying a franchise business when there's real estate underneath, or you're building a franchise business where there's real estate underneath, we can help with that. Relocations and recap/cash outs as well. Okay, so let's get into the loan products. We're going to kind of start here and make our way up. So the first is the traditional SBA. So the SBA is really great typically for first-time or newer franchisees. With that being said, there are benefits to it for very tenured franchisees as well. On average, the SBA, when they're looking mostly at new unit financing and acquisition financing, they're looking for anywhere from 10 to 20% down of whatever that all-in project cost is. Liquidity in any scenario is very important. What the SBA typically is looking for, which is a question a lot we get for first-time franchisees. After that 10 to 20% down, lenders on average want to see that you could show 6 months worth of the monthly payments of the loan post-closing of the loan in your liquidity. And by liquidity, lenders are looking at like checking accounts, savings accounts, stocks, and bonds. Those are the four main things. Something to note with the SBA, for loan amounts that are $350,000 and above, they do require outside collateral. As many of you know, the SBA is backed by the government, so there are certain rules that the lenders must follow, this being one of them. Typically, it is second lien or best available lien on a home. If not, it could be like a property that someone might own if it has 25% or more equity in that property. The great thing about SBA is they can include working capital into their loans. A lot of times, most of the times, conventional lenders cannot do this. There's two main SBA products. There's others, which I'm going to talk about on the next slide. There's the 7A and there's the 504. The 7A is really good for, just financing the operating company of a new unit or an acquisition. They can go out to a 10-year term. If there's a real estate purchase involved, that is the 504 program, and they can go out to 25 years. On the 7A product, they max can go out to a $5 million loan, and 75% is backed by the government. On the 504 program, they typically can go a little higher than like a $9 million loan all in. 35 to 40% of it is backed by the CDC, and 100% of that is backed by the SBA. Something to note, there are no prepayment penalties on the 7A program. Still focusing on the 7A side, prime right now, it goes based off of prime rate, which is 6.75% today. And then it's a spread over that index. Typically, it's anywhere from 1 to 2.75 over prime, which spits out the rate to be around, somewhere in the 8s or the 9s. It could be lower than that for stronger opportunities. On the 504 side, typically the rates are lower because the CDC rates are lower. In regards to credit score, this is very important. On average, these SBA lenders are looking for scores 670 and above. With that being said, if you had a lower score, but there was a story behind it that they can understand and get around, then they could potentially get around it. And then all in, the SBA, the traditional SBA, is about a 2 to 3 month process. Of course, it's going to be dependent on how fast you as the borrower are getting paperwork in. If you're buying a unit, how motivated the seller is, and other factors like that.
Yeah, great job, Lex. And just to mention and jump in here, so we get calls, especially from SBA lenders all the time that want to work with us and therefore work with you. So we vetted them. So we know which SBA lenders have their own specific franchise group, which is really, really important that they understand your business and the ups and downs of brands and things like that. Because you can go to a local bank and get an SBA loan, but you really want a vetted group that understands the franchise language and lingo.
Mhm. Okay, the next. The SBA small and express loans. This has been an interesting product where we've had a lot of clients go through. And the reason I say this is because the clients that have been utilizing this of ours are new franchisees and they're also very tenured franchisees. So it's a little different from the previous product I described. They're similar. The only difference really is the loan amount. So in terms of small versus express. So the express goes up to a $350,000 loan. The SBA small goes up to a $500,000 loan. Now, the express is open to more brands. The small loans are more limited to those, top tier concepts. This is a nice product because there is very minimal paperwork required. Um, all in, they can close in as fast as 3 to 4 weeks, start to finish. On average, you're looking at 10% down, and this could be good for, remodels, new units, acquisitions, and they can actually do straight working capital loans. And it's nice because they're not at like those credit card rates. If it's not a straight working capital loan, they still can include working capital in the other projects. There is no outside personal collateral with this product, so you will not have a lien on your home or your property. You still get the benefit of the 10-year term, the 10-year amortization, no prepayment penalties. And just to clarify what we mean by that, if you were to refinance your loan or you wanted, you hit the lottery and you want to pay cash and pay down the loan, you won't be penalized for it. The rate is slightly higher. Again, you're looking at a prime rate. Spread is around 2.5 to 3% over, puts you in the average rate today of the nines. Now, keep in mind, for a smaller loan amount, the monthly payments don't change that drastically with the rate difference. If you were to plug it into a loan calculator, you could see. And then lastly, you're looking at the same thing with the credit score. Typically, they want to see 670 and above. Okay, the next product is a conventional product. This is what we like to call app-only financing. So this one is really geared towards existing franchisees, individuals that have been in business for 3+ years. This product is good for people who need to move quickly. Maybe they're late to the game or something fell through with another lender. Or if maybe your financials aren't that strong and you need to go a route that they are not going to be reviewing your financials, this would be the product for you. These lenders, there's a couple of them out there. The highest that some of them can go out to in a loan is 550,000. The other great thing about this is they could do second lien or PMSI financing. So let's say you are seeking financing for a remodel, right? And your existing lender, they're not willing to help you on the remodel, but they have first position lien from the original loan you did. This lender can come in comfortably and be in second position. So what's the approval based upon then? It's based upon brand, credit score, time in business, and bank statements. The stronger the profile, the lower the rate's going to be. So by that, stronger the time in business, stronger the credit score, stronger the brand. If it's more of a top tier brand, a lot of them have like tiered structures dependent on the brand, the lower the rate will be. On average, the rate is anywhere from 8 to 10% today. It could be higher, it could be lower. Again, it's dependent on those factors. A lot of times for these type of products, especially if someone's having trouble finding financing and this is the route to go, we always say it's more about access to capital versus the rate of capital. These lenders will go out to a 5 or 7 year term max. If you wanted to go lower than that, you could. Some of them will do it on a 10-year amortization, so you'll have a balloon payment. And then when it comes to the down payment, anywhere from 0 to 10% down. And these units, I'm sorry, these lenders for the app only, just to be clear, they're not doing acquisitions or refinances. In those scenarios, they would need to look at your financials. This is really good for like equipment upgrades, remodels, and new units.
Right. As Alexa said, it's really about speed here, right? So if you want to go through full financial review, which we're going to get into shortly, um, that's a different product. But this is about speed. And they could do some tougher brands. When I say tougher, I mean more emerging, smaller brands that maybe some lenders wouldn't touch, but they could be very good brands, actually. We also have an app-only lender, to throw it out there, that the rates are like credit card rates. That's our last stop, right? We call it like the Alamo. So if you really can't get financing anywhere, but you need just say $200,000, whatever it may be, we have a lender that could offer credit card type rates. You do interest only for 6 months. Once a store gets open, whatever it may be, then you could pay it off. And as Alexis said, on small dollar amounts, the needle doesn't move very much on the monthly payment. The other thing I wanted to point out about during the application only product is where one of the intangibles of Linsky Capital comes in. So some lenders on the app only would do a prepayment language of what we call a 5-4-3-2-1. And what that traditionally means is 5% penalty the first year of the remaining principal balance, 4% the second year on the remaining principal balance, so on and so forth. There are application only lenders and other lenders that their language is a little interesting. They will say things like, if a franchisee goes alone and speaks to one of these lenders and says, well, what's the prepayment language? They say, well, we'll offer a 5% discount. So in the lender's mind, it might be what I just mentioned, the 5-4-3-2-1 based on principal balance. But what the lender said was different. The lender may have said a 5% discount. So what that might mean to them, and you find out late in the process or never notice it, is that they will, what they call PV, present value out all of the remaining stream of payments, principal and interest, and take that amount, even though you're prepaying after year 2, they're going to PV it all out and discount that by 5%. That equates to a much larger penalty than a typical 5% or 4% of principal balance. We've had clients that originally went on their own and said, oh, no, I know people, I could do it on my own. And they called us a year later and say, boy, I went to prepay and it was like a very, very large amount to get out. And I said, yeah, because we would have had your back and we would have explained that difference in wording to you.
Mm-hmm.
Okay, small ticket conventional financing. As Alexa mentioned, we're kind of working our way up here on deal sizes, et cetera. Typically reserved for loan sizes of 100,000 to about 5 million. Full financial review is needed here. The checklist we had mentioned, we're going to review it, submit it. They're going to analyze it, underwrite it, et cetera. Okay, they're going to look at not only the units that you might be looking at, i.e. an acquisition, but all of your other existing businesses as well, globally. Typically, they want 10 to 20% down. Um, One nice thing about refinancing, and there's a lot of benefits, such as lowering your monthly payment and consolidating lenders and whatever it may be, is that you can possibly get 100% financing on new stores or remodels if you couple it with a refinance and use embedded equity of the existing collateral. So we always go over that option with you. What's nice about a small ticket lender is they don't have to do that. They don't need the whole relationship. They can, the word we use is go naked on units. So you may have existing debt. You don't want to touch that debt, but you want financing for a couple of new units. A small ticket lender is willing to do that. They probably want corporate guarantees, of course, personal guarantees, but they don't have to refinance your whole portfolio. Typically, it's up to a 10-year amortization, typically a maximum 7-year term on the loan. The prepayment, again, is typically a 5, 4, 3, 2, 1, a sliding scale of remaining principal balance. We try and negotiate that down. Again, we're just giving you basic parameters today. Rates depend on a few factors, but typically rates for a small ticket lender are anywhere from the upper sevens to the low eights on an average range. Again, if it's a really great deal and we can get lower, etc. They do want a first lien on any unit that's being financed. There's no second lien financing here. They typically underwrite to straight leverage. So basically funded debt to EBITDA. And they'll go up to about 4.5 times on that on average when they review the global and the specific collateral. This type of lender, you're using credit for 2 to 4 weeks. And then documentation could be, again, 2 to 3 weeks. And then you could be from start to finish, let's call it 6 weeks or less. You'll have money in the bank account.
Something I just wanted to add real quick. When we're talking about rates, this is what we're seeing today, and they've kind of held steady like this for the past couple months. Obviously, when we did this webinar a year ago, these numbers were different. So just keep that in mind as well.
So next up is mid-ticket conventional financing, where I spent most of my career. Typically, loan size is a 500,000 to about 35 million hold position at the lender. Full financial review, again, is needed. Same thing, subject units, global review. Same thing about money down, couple it with a refinance. One difference with mid-ticket is they can sometimes go up to a 12-year amortization, which, again, you want to pay down debt fast if you can, but especially if you're building fast or you're acquiring a distressed network, it's nice to have a little extra wiggle room in your monthly payment every month. Same thing, they typically do about a 5 or 7 year term. They typically, after that, would do a balloon payment. Some lenders will just do a rate reset on a predetermined spread over an index. Prepayment, similar to the last slide, the rates get lower. So now it's a bigger deal, typically a more tenured operator, a larger operator. So then we start seeing rates sub 7, right? So they're somewhere in the 6s, usually mid to high 6s to mid 7s, depending on leverage and brand and things like that. Same thing, they want to lean on anything they're financing. Now we start getting into not straight leverage, but also some lenders start transitioning at the mid-ticket level to what we call rent-adjusted leverage, lease-adjusted leverage. Basically, what you need to know for today, and we can get in more detail one-on-one, but rent-adjusted leverage and lease-adjusted leverage is typically today, with higher occupancy costs, about maybe 1.5% higher than the straight leverage in terms of the covenants and how high they go. Same thing in credit for typically 2-3 weeks, depends on how backed up. With a mid-ticket lender, some lenders want some treasury management. So that can mean they want to start developing something where you at least open a business checking account, you throw $200,000 into it, some type of banking relationship. Some lenders, depending on deal size, they want to start sweeping the account so you can deposit around the corner, but then they're going to do a sweep of the accounts and they want the full treasury management. So mid-ticket is kind of in between where it's not a clear line on what they're looking to do, but that those are kind of some of the variables on what they may be asking for. Okay, large ticket. So typically, the large ticket lenders are looking for loan sizes of at least 10 million, and that's on the low side for large ticket lender. And they will go over 50 million hold position, but they can go well above that. So we could do literally a $200 million loan. We call it a club deal, or we get participants. Well, a few lenders will go in together, and they would lend you the $200 million with a certain lead on the transaction. Again, full financial review needed. Same thing, money down, possible 100% financing if there's a refinance. What's important here with the large ticket lenders is that they're going to want to pretty much have everything. So if you have a really large network in one brand, and then you have a large network within another concept, they might be able to keep that separate. But otherwise, they want to be your go-to lender. They have all your collateral. As you'll see down the slide, they want your full treasury management. They're really looking for relationship. They're lending you a lot of money, and they want to know you're committed to being a partner with the bank and do everything together: the banking, the loan, the collateral, etc. Typically, amortizations are 12 years. We do have lenders that would go out to 15 years on opco debt. So on real co-debt, if there's real estate involved, they can go out to 15 or 20-year amortization if it's a ground lease. If it's a fee simple situation where there's land, building, and equipment involved, they can typically go out to 20 or 25 years on the amortization. Same thing, typically a balloon after 5 to 7 years. One thing different with the large ticket is that in regards to prepayment, there's not typically the 43210 sliding scale. There's usually what they call a swap component. And what it means is they basically want to swap out half of the deal, and there's a prepayment and breakage fee if you refinance. Just know that if rates go up, usually the fee is higher. I'm sorry, if rates are down from whatever you locked in at, then there's going to be a breakage fee. If you lock in at a rate and rates have gone higher and you get out of it, you can actually make money on the breakage, on the swap. Rates can be very low here. So different lenders tie to different indexes, right? And again, we're trying to not get too detailed today, but we can always expand on one-on-one calls. Some lenders tie to prime, like SBA. Some lenders tie to, let's say, treasuries. Some tie to what we call FHLBs, Federal Home Loan Bank of Boston, typically. And then large ticket lenders typically tie to 1 month SOFR. All right, it used to be called LIBOR quite a while back. Now it's called SOFR. So rates could be very, very low. So for very large transactions, large operators, we literally are seeing rates in the low sixes in that ballpark. They want to lean on everything. Again, they want the entire network typically. They do work only on rent-adjusted leverage, lease-adjusted leverage, not funded debt to EBITDA. And one nice benefit of the large ticket lender is that there's typically no PGs needed. So they figure, listen, if we're going to lend this kind of money and we trust this operator, we really don't need them to sign personally, no personal recourse. We believe in the operation and the collateral that we have. These lenders will basically always need your full treasury management, as mentioned. Okay, so another type of lending that we offer, and we do quite a bit of, is what we call private equity-backed lenders and financing. So the majority of the previous lenders are banks, and they have to follow bank regulations and rules and things like that. There are franchise lenders that are really great, and they're very active in the space, but they're not bank owned. So they can basically do whatever they want. And they don't get too crazy, but what they can do is be flexible, creative, and fast. So as you'll see with the rates, which are typically in the eights, Rates are a little higher, but they may do a deal that is bankable, but maybe leverage just got a couple turns too high for a traditional conventional lender. That's where these lenders come in. They can also do some interest only periods, which really all the lenders, we could negotiate some interest only, just to throw that out there if it's a new store or sometimes even an acquisition. Same thing, they want liens on everything. They typically underwrite to rent adjusted leverage. They can go higher, right? So the other lenders are at, call it 4.5 funded debt to EBITDA, 5.5 lease adjusted leverage. These lenders can go 6 times. We've seen 6.25 times. Again, they'll do more creative solutions for slightly higher levered deals, and that's where these lenders come in. They're very quick. They're very flexible. And another added benefit is they do not need your treasury management. So some people like to work with these banks or these lenders, not a bank, just for that reason, that they don't have to switch over their depositories and sweep the accounts or none of that stuff.
And one thing to add, because we get this question a lot of times people think in their heads when they hear private equity backed that these people are investing in the business as investors. They're not. They're acting as a bank, providing the loans.
Right.
All right, this is our last section before the Q&A. I see some questions we got, so thank you, and feel free to keep adding them in. We'll answer them after this. But lastly, we want to talk about tips to increase chances of loan approval. We want to see what has helped or not helped with loans getting approved or not approved. So the first, communication is everything. A lot of times, if people don't address hurdles up front, it could literally be the difference between a deal getting approved or not approved. One example is, let's say that one of your units, the sales were down, and you address up front that the reason behind that is because there was a remodel going on, or maybe there was road construction. Lenders would totally understand that story. We understand that story, and they can massage the numbers to make the deal work. The other thing is responding timely. If you want us and the lender to be focused on your deal and moving it along, the quicker you are, the quicker they're going to be. Next, being organized. This is something that we help out with. As my dad mentioned before, we provide blank unit detail sheets, debt schedules, personal financial statements for our clients to fill out. This helps you be organized, sharing when are your remodels due and what are the costs, because we might need to factor that in. If we're looking at a refinance with a line of credit, we can possibly include that in the line of credit. When do franchise agreements and lease agreements expire? Are there options available? This is something we ask on our unit detail sheet, and this is important. If there's a lender that's refinancing all your debt and one of the leases is expiring in 2 years, but they're about to term out your loan for 7 years, well, that's the problem. And next, know your business. Lenders like operators who are hands-on, they know what's going on, they can answer questions extremely fast if they pop up. If there's a franchisee that isn't really aware that's going on, they're absentee, we see problems with that. So definitely keep that in mind.
Yeah, and just a quick story I like to tell from years ago. I was working on 2 deals, and they were both right on the verge of whether or not they were going to get approved. And I went out with my chief credit officer at the time, and we said, listen, let's go visit the site, visit the operator, and go from there. We went to visit the first operator, and when we walked in with the operator, there was like some napkins and straw wrappers on the floor, and the operator kind of walked right past it. He went in, and the managers didn't even know who he was, and he's like, hey, what do you guys want? And he basically was like giving us donuts and coffees and this and that, and just going back there. And you would think he's the owner, he should be able to do that, right? Then we went on the second meeting. The store was meticulous. The operator said to us, hey, do you guys want some food? You want a coffee? Whatever it may be. He actually got in line. He paid for the product that he gave us and himself. And I remember saying, "Well, why are you doing that? It's your unit. Why are you doing that?" He said, "Well, the franchisor, pays attention to sales and royalties, but honestly, when I pay, you better believe that every employee knows that they have to pay. No discounts for them in terms of no free items for their friends. If I'm paying for my friends, you guys, then they're going to pay as well." So he was setting an example. When he walked into the unit, the employees, "Hey, Bob, how you doing? Good to see you. This and that," or, "Hey, I wanted to get back to you on that thing from yesterday." Very engaged. And without me telling you the final outcome, I think you figured it out. And that is the first deal got rejected, the second deal got approved. And even though that was in person, it's the same type of idea with what Alexa just went over. And that is know your business, understand how has inflation hit you? How are chicken prices? Why is the one unit down? It was self cannibalization. It was too busy. We could fit another unit, whatever it may be. So even though it's verbal, the analysts, I can promise you, are going to be listening to you. And if your deal is on the border in terms of metrics of getting a deal approved, right? The leverage, the FCCR, all these different things, it will make a difference whether or not you get a deal done. And then going back to communication, we always tell people, listen, we're going to put in time, we're going to work with you. In any relationship, business or personal, communication is key. And we always tell people the worst thing you could do is work with us or work with a lender for weeks and then disappear. If you ended up going with someone else, that's okay. If in the beginning you're talking to two lenders or two brokers, just communicate that. No one's going to be mad at you, but just communicate, because when you come back 2 years later, and we see it happen all the time, people come back and the lender says, "Oh, I remember this guy. We sent a proposal, spent all this time, ran it up the ladder, never even would get back to us on our calls or emails. No way are we looking at this deal." Because all these brands have highs and lows, right? All the brands. And you may think that you're at a high and you could do what you want, but someday, everything that goes up must come down. It's just a business, and we understand that. But people will remember. So make sure you communicate and have a professional courtesy.
Yes. All right. So that is everything we wanted to cover. I see some questions. Again, thank you guys. Thank you everyone. Good questions are popping up, so I'm going to read them off. I did just want to say one quick thing. If you have any financing needs, or I know there's a lot of franchisors on here, attorneys, accountants, if you know of anyone seeking financing, please send them our way. We would love to help. We would love to understand their story, what they're looking to do. This is our contact information. You obviously got my email, so you have my email if you need to contact us, but our website is just www.linskycapital.com. Thank you again. I'm gonna stop sharing and I'm gonna read off the questions.
And there's also, I see in the chat. So if you guys can enter them in the Q&A, but there's also some comments in questions in the chat side, Lex.
Okay.
Can you see it, or do you want me to go through it?
Yep, I can see it. Okay. One question someone asked is, what about 401ks for liquidity? So typically, no, lenders are not looking at that. They're really looking at checking accounts, savings accounts, stocks, and bonds. There are a couple of companies out there that will do the rollovers, but not many. So we have seen situations, unfortunately, where people will come in, they'll have, a lot of money in their 401k, but they don't have a lot of money in, checking accounts, savings accounts, stocks, and the deal is not bankable.
Yeah, there is a ROBS program, so we are connected with one or two groups that can help with that, though. So if the majority of what you believe to be liquidities and retirement accounts, like your 401k, we can get that rolled over and figure out a way to make that more liquid from the lender standpoint.
Mm-hmm. Any lenders that will lend to green card holders. So, as many of you are aware, the SBA recently changed the rules. So now everyone on the SBA side, at least, 100% adding up to all the owners need to be US citizens. There are some conventional lenders that can get around it. It would be obviously helpful because they're conventional if they're a tenured franchisee, cash flow strong. If there's other partners and they're US citizens, that would help the situation as well.
Yep, and just some other questions
Yep.
on the same thing. For new franchise startups, do the rules change? Are there any rules how long the franchisor has been operating and how many locations? So if it's SBA, there's a registry, and they have to be on the registry to be considered for financing. So that's number one. Most franchises are. How it changes is the okay, so there's different tiered brands, right? Think of like Taco Bell, Dunkin' is tier one, and then you have tier two, tier three. Basically, the stronger the brand and the more units and the more nationwide the brand is, the longer tenure the brand is. That's like a tier one. And again, it goes down. So it changes in regards to the concepts based on lender. So getting back to the app only and the SBA and the small ticket lender, right? They're going to have if you look at a funnel, they're going to do more brands, right? As you borrow more money and get into mid-ticket financing, they're going to do less brands. And then when you get to the tier one, the large ticket lenders, they're going to be looking at mostly tier one. So they're going to, some of the large ticket lenders are literally only going to finance like 10 concepts tops in the country. So yes, it absolutely matters what brands you're getting into in terms of how many options we have and things like that. Are personal guarantees required? We went over that. They are required unless it's a large ticket lender, a large deal, very tenured, low leverage, etc. With mid-ticket conventional lenders, we can occasionally get no PGs or what we call a PG burn-off. So basically, if it's a nice deal, good brand, and the deal's $7 million, we have lenders that might say, okay, listen, if they pay us for 24 months on time, their leverage has come down, which should, as you're paying down principal, et cetera, we can burn off the PG. We'll have a provision after 2 years, et cetera. But typically, PGs are warranted and needed. And again, unless it's a really large deal where you kind of deserve no PG. What is your engagement fee and deposit? So we work different with different banks. In regards to deposit, as you can imagine, we do a lot of work up front. We're incredibly busy. It's just when we proceed with the bank, you sign the proposal. That's when you sign our agreement. It depends on the deal size. If you're only borrowing, $500,000, it might be a $5,000 deposit. If it's a $35 million deal, which we've done, we may ask for a $25,000 deposit, which is a very small percentage based on that loan size. We have wording that if the deal does not get approved, that the deposit will be refunded to you in its entirety. We don't take anything out for time and costs and anything else. So that's how the deposit works. Our engagement fee is typically, it depends on the lender, et cetera. Depends on the brand, the deal size, there's a lot of different factors. On average, it's 1% from the client. Really important to note that we don't have the lenders charge you a point, and then we charge you a point, and then you're double paying to use us. So first of all, there's brokers out there that charge 2% or more, which we're only charging typically 1%. Number two, when we do work with lenders, if they say, well, we want a 1% origination fee, we say, no, we're not going to work with you. So most lenders we work with will waive the origination fee when we're involved because they want our business. So then you just pay the 1%, and or they will really greatly reduce their origination fee. So we always say that our services are typically little to no extra cost. By the time we negotiate the rate down, we get the lender to hopefully waive the origination fee or greatly reduce it, et cetera. Let's see here. A couple nice comments. Thank you.
Oh, I see a question we didn't answer. Will you do non-franchise deals? No, so we're really just specific to franchise financing. It's what we're good at. It's what our lenders are good at. Something we should add that I don't know we mentioned before. So all of our lenders have divisions that are very specific to franchise lending. Some of them are even more down to that to franchise QSR lending or franchise fitness lending. So unfortunately, we are only specific, not unfortunately, because it's what we're good at, to franchise lending.
Okay, I think that was it on the
Is it
comment side. Thank you for some nice comments. We appreciate you very much. To the
yes,
Q&A,
you. Yes. Someone
please
asked,
fire off questions. We love questions.
yes. Someone asked, is it good to buy when brands are trending up in sales or down? That's a good question.
Okay, do you want me to answer that one or? Okay, so the question again is it good to buy when brands are trending up in sales or down? So as mentioned before, brands go up, brands go down. It's just the way it is, right? Especially over time. Something that's hot today may go down, vice versa. What we think is this: if a brand is really hot and newer, and you could buy into the brand to get it into the territory, and there's what we call a lot of white space to grow. We think that's a good idea. The brand's hot, still going up, no signs of slowing down. You can sign a nice development agreement once you buy a few units or get into, that acquisition. So even if something was down, maybe it's a poor operator because the brand's been hot. If it's a brand that you believe in that's been around, like Popeyes, we love Popeyes. So Popeyes has had a little bit of turbulence, and I think it'd be a great time to buy Popeyes because Popeyes will definitely rebound, even though they're not down a lot. Same thing happened with Burger King, right? Burger King went through a tough time. We're very close with corporate. We go out to Miami and we're very close with RBI. We love Burger King. We love the people. And we were telling people when people would ask us, hey, what would you buy? What brands would you buy? That was one of the brands we would mention. And they're like, really? Why? It's been getting crushed. Like, some people, some large franchisees had filed bankruptcy. We'd say, listen, we know the inside scoop. We've met with all the senior corporate people, the very, very top people at Burger King corporate at RBI. We believe in the brand. They've got a great plan. They are going to execute on that plan. They're going to have a remodel mandate coming out. You can get in now when things have not been so good, and you are going to make money fast on your acquisition. What I wouldn't do is buy into something when sales keep going down and there's no strategy to stop the knife from falling. So if something is down 5% one year, 7% another year, there's no great products coming out. The leadership every couple of years is jumping in and out. That's something I wouldn't get into personally. I also think it matters on the size of the operator. If you're a large operator and basically what you can do when you buy a network and turn it around, great. If this is the first time getting into something, or you're a 2-unit operator buying 4 more units and it's a risky proposition, I would stay away from risky propositions if you're a smaller operator.
Um, okay, I can answer this question. Good question. If you need financing for 3 units to be remodeled over a 3-year period, how early would you start checking? Also, is it better to secure funds upfront or the amount needed as they get remodeled? Okay, good question. So, with remodel financing, we have a couple different routes. My question back to you would be, do these existing units have debt? Because if they do, we would either have to refinance all of your debt and we can give you a line of credit for those remodels, which they can go out for 18 to 24 months. Now, yes, the lender's likely going to extend that if you have a relationship with them, if you're over that 3-year time period. Or another option could be that app only financing. We have a couple different app only lenders, so we can go to one here, one there to knock out your financing. If you're late to the game and you need that remodel financing, the app only is what we would recommend. When in the question of how is it better to secure the funds up front, for the remodels. For anything, we always tell our clients it's better to have the money sitting there waiting for you versus you waiting for the money. A lender could reapprove your deal if needed. So always early, always better to start early. With the remodel, a lot of times it's like, are you kind of aware of what the breakdown of costs are going to be for that remodel in order for them to actually approve you? But good question.
We have a question here up top. Do you require or suggest your clients who are seeking financing to obtain life insurance to protect against the debt? Boy, that's an interesting question. We've never believe it or not, we've never had that question. I think some lenders require it,
Yes,
right? Some lenders
the SBA
require it.
a lot of times does.
Yeah, some lenders require that there's life insurance in place that God forbid something happens to you, that the loan could be paid off by your executors. But that's more of a question for, I'd say, a financial advisor, but that is a good question. But the answer is typically, it is often mandated. I heard something about a deposit when I joined. What is the deposit amount and based on what?
I think
Again,
I think
we
they type that after we or before we.
oh, okay. Oh, okay. Yeah. Yep. It's just a number we come up with just to know you're committed, just like when you buy a house or whatever it may be. Um, sorry, I'm trying to.
Define bankable.
Okay. So define bankable. Well, bankable means different things to different people. Bankable is going back to that preliminary call that we have with you and all those questions we ask. You could have a lot of units and a great brand, but you have $50,000 in your bank account, they're not going to approve it. You have no liquidity. If your leverage is high, right? Again, we went over the slides of the kind of covenants and the credit parameters that lenders are looking for. If you're outside those parameters, it's not bankable. There are things that we haven't talked about, like how fast are you growing? If you have 3 units and you're looking to build 4 units in 1 year in the next 12 months, that's a little harder. If you've got 30 units and you're looking to build 4 units in the next 6 months, that's very doable. It's really case by case. We'd have to jump on a phone, ask you all those qualifying questions to give you an idea if we think it's bankable.
Any other questions? I think we.
Here's one. If someone wants to refinance their loan, but they have prepayment penalties, can the new lender finance the penalties? Yes. The answer is yes. When the lender is they typically don't reach out to the existing lender to the very end of the transaction. We've done everything. We're about to fund. Loan documents are being prepared. The new lender will contact the old incumbent lender and get a payoff letter. And that payoff letter will detail the instructions that they will release the liens on the existing collateral, and it will include the payoff amount, which will include any payoff prepayment penalties. We still have a little time, unless anyone has a hot date, no problem. But any other questions? We really enjoy the questions. We'll just wait a minute here, and if not, then we'll wrap it up.
Oh, I think your camera went off. Oh, there you are.
Okay. Al Bakhta, great info, nice job. Thank you, sir. Appreciate you. We got to catch up. Okay, guys. Well, if that's it, just appreciate your time. And as Alexa mentioned, we give free expert consultations. You can reach out to Alexa, myself, reach out to Isabella. We really appreciate everyone's time. We know your time is valuable, and we would love to work with you guys. So reach out. Let's have a one-on-one call, get more detailed, and hopefully this was helpful for you guys today. We'll be doing it once or twice a year. And
We got a question. If I'm buying real estate, can I lump together the cost of developing the property along with the cost of building out the brand into one loan? It's under the
Sorry. Oh, yeah. Okay, good. If I'm buying real estate, can I lump together the cost of developing the property along with the cost of the building on the brand into one loan? So the if you buy the land and you're buying or constructing a building, that would be on the longer amortization. What they may do is the equipment, which is at that point it's pure equipment, right? It's FF&E because the leasehold improvements, the construction is falling onto the other side of the longer amortization. Some lenders are going to want you to put that on the 7, 10, or 12-year amortization, but usually when you look at just the FF&E component, it's $500,000. I mean, it depends on the brand, 200,000, 700,000, whatever it may be. So typically they do separate it, OpCo versus RealCo. But if you have a lot of, if it's a refinance and you have a lot of embedded equity, they can do more creative structures and maybe do everything on the longer amortization. It's really case by case.
Anything else? Any other? Again, you could reach out to us direct if you have a specific situation for yourself or for a franchisee you don't know the answer to. We'd be happy to answer it.
Thank you, everyone, very much for your time today and hope to
Yes.
hear from you soon.
Thank you so much, everyone. Have a great rest of your day.
Bye, guys.